Yeah. I mean, it's amazing. If you can get into this place and finance it for half a century. No, I said 599. Are you out of your mind? You don't need a 600 anymore. That's what I'm telling you. It's go time. You don't need a 600. No, see, that's the thing, see? Like 619 is plenty. You don't need 620. That's what I've been trying to tell you. Look, it's a 50 piece. It's a 50 piece. I mean, if you could have a 50 piece over a 30 piece, just trust me. I'm the MVP, man. I'm the MVP. Guys, here's the truth. You don't need a 620 FICO. You've never needed a 620 FICO, and you absolutely do not need a 50-year mortgage. Here's what buyers need today. They need education, they need preparation, they need some dedication, they certainly need collaboration, and they need a little bit of guts and faith. Let me share it with you on this weekend update. Let's go. Okay, welcome to the weekend. More importantly, welcome to the weekend update. Now, look, I'm going to get into some things about that intro, but I got to start off with some bad news. Lost some of my favorite charms to my Crocs. I used to be Papa, now I'm Pa. So maybe that's just getting older. Comment down below if you've ever lost your favorite Crocs charms. But seriously, folks, let's get into the weekend update. I'm going to do a screen share. This is going to be a deep dive, and with the magic of Autumn and the marketing team, we'll probably split this up into some multiple videos just so you can dig in and get the information that you want on the things that you need. But I think it's all important, just whether or not you have the ability to dive deep into the solutions and what's going on in the market that are going to move the needle for your buyers, your sellers, yourself maybe, and all in all, your clients. Let's dive into the market with a quick split screen. Okay, so we've been talking about the fact, and when I say we, I'm talking about folks in the industry, and specifically someone that I'm really close with, probably one of the best market analysts that I know in our industry. And there's a lot of them. Some I don't I don't trust, I don't listen to, and others that, like this individual, see things in a really helpful way, and that's why he's so good at what he does. And thankfully, I work with him. Now we're seeing a flight to cash. Some would call that, in some ways, a flight to safety. Part of that is because for the last 45, 60 days, we've been flying blind, which today we got our first Bureau of Labor Statistics jobs report. We've had some private market data, but for the first time, and normally this happens on a Friday, but on a Thursday, we get not the October, but the September jobs report with some mixed data in there. We certainly had a lot more jobs created in September than was anticipated. I'll actually give you the number here. The projection, the forecast was 50,000 jobs. The number came in at just under 120,000. So we were more than double the projection. The unemployment rate edged up from 4.3 to 4.4%. So kind of a mixed bag. And what we've been seeing, especially while we've been flying blind, so to speak, without some of this labor data, amongst other data, um, we've seen people pull back and sell both stocks and bonds. Earlier this week, we saw that flight to cash, and we saw uh, bond yields rise. It means people were selling bonds, and we saw the Dow and the Nasdaq stock markets drop. So we had people going cash. Today was kind of a different story. The we saw the stock market and equities really take the brunt today. It looks like we're trying to bounce back a little bit in after hours trading. Futures are up 184 on the Dow and just a little under 2% on the Nasdaq. So trying to claw back. But what we definitely saw were losses today of almost 1% in the Dow and over 2% in the Nasdaq. That money flew to safety in the form of treasuries, and we saw a little bit of relief, maybe improved interest rates tomorrow ahead of next week's holiday week, which will be interesting. So mortgage rates are down a little bit based off of that, but we're overall in an environment where there wasn't enough data for investors, both institutionally and individually, to know what to do. So we saw people going cash. Now we're starting to see a little bit of flight to safety in bonds, which is going to help us out on interest rates a little bit. If you want to take a super deep, dorky dive, I'll link a white paper here titled Central Bank Access and Flight to Safety. Now, this is an interesting white paper put out by the Federal Reserve Board. It discusses things like the liquidity crisis in the Great Recession in 2008. And then what we also saw again as recently as COVID, when there was a flight to safety, so it's called, or people basically pulling cash from depositories. And we saw that happen with Silicon Valley Bank, and more locally, we saw it with a great bank here in Del Mar, First Republic Bank. So no longer around. They are now owned by JP Morgan Chase and Jamie Dimon. So this is a paper talking about the facility that creates liquidity for banks in a time of financial stress. If you're a super geek and you want to read it, check it out. If you want to dive in to the numbers for existing home sales, up slightly, increase of 1.2% seasonally adjusted year over year, decrease in unsold inventory down a little bit. So it looks like maybe the inventory side is tightening a bit. I'll get to more on that in a second to see if we're just getting regular seasonal tightening. People want to take their home off the market in November, December. We see that every year. And is that something that's happening? And where we might see a little bit more inventory coming up into the first of the year. If you want to geek out even more, I've talked about all things financial before. This is a great daily watch if you really want to see what's happening, not just in the US, but you want to see how global economics could be impacting or forecasting what's happening in the US. Check out and follow all things financial. Interesting title here. He who solves a problem with a problem will always have a problem waiting. And if you know what's been going on with Japan, they've been in a deflationary environment for, I think, well over a decade, trying to raise interest rates, certainly since the Great Recession, and been trying to raise interest rates. Now they're doing this, but the stress that that's putting on the public, just your average consumer in Japan, has been weighty. And so they've got a stimulus package that, for the numbers not here, over $110 billion, basically saying the price is no object. We need to get stimulus into the hands of households that are fighting both rising costs of all goods and services, as well as rising interest rates, because their central bank has been in a deflationary sub 0% interest rate for well over a decade. All things financial. And another great watch and follow is the Lending Perspective YouTube channel, at Lending Perspective. Go to YouTube, type in the search bar at Lending Perspective. Make sure to use that at there, because we're not so big that we're just going to pop up like Peter McKinnon or Joe Rogan. But please like and subscribe, and then you'll have access to our full library of not only weekend updates, product highlights, mortgage dashboards for clients, and more. So please, thank you for those that already have, and the rest of you, please like and subscribe to the Lending Perspective channel. More links to share with you in just a second. Okay, so the intro to this weekend update was kind of a spoof on things that you don't really need. They've eliminated a 620 FICO. I'm going to show you and raise some questions about that on a second. And they've also, and I say the Trump administration is talking and floating this idea of a 50-year mortgage. And as I always say, and hopefully you know by now, you cannot expect what you don't expect. And so, like almost that theme of solving a problem with a problem, one of our highlighted homes last week, San Pablo in Lake San Marcos, right on the golf course. And I already had a mortgage coach drawn up for open houses and clients interested in this home. If you're interested in San Pablo, and we'll keep a link there so you can see it. Great home on the golf course, the big golf course at Lake San Marcos, right next to hole number 11, the par 3. I'd already put this together, but I want to point out, as we would with any client who's considering maybe, hey, Sean, would a 50-year mortgage make more sense for me? So let me clear this for a second and show you. Column 1 was if you were just buying a house with market rates. Here's what it goes for. Your payment on a $1.3 million house, 20% down. Boy, it's chunky. It's like $8,200. Now, if you negotiated a seller credit and you're a smart buyer, aka Mr. and Mrs. Smart Buyer that I've often labeled, right? You would ask for a 2% seller credit. You could use that seller credit to get your interest rate on a 30-year fix near 5.5%, just over that. And your payment would drop nearly $600 a month, $595. Now, if you did a price reduction, unequivocally, you'd save some money, but your payment would actually only decrease about $300 if you got a $50,000 price reduction. So, want to save $600 a month in perpetuity for 30 years, or you want to save $300 a month in perpetuity? It's a pretty easy answer. Now, 50,000 or 50 years. If we look at the 50-year mortgage, right? We're going to save $320 a month. We're still saving far less than if we got a 2% seller credit on a 30-year mortgage, where that payment is $7,600. The payment on a 50-year mortgage is still nearly $7,900 a month. But guys, here's the big thing, right? Over 60 months, that 2% seller credit on a 30-year mortgage with a rate of nearly 5.5 is going to save you $65,000, just under, where a 30 or 50-year mortgage with likely a higher interest rate because it's a longer term. That's no secret to anybody. The longer fixed term, the higher the interest rates, aka 15 versus 30 years. So even if it were just a half a point over, and the way the interest is amortized, you're saving zero, nada, nothing. So 64,000 savings, zero savings. And then look at this, guys. This is the real eye opener. Over the first 10 years, if you had a 50-year mortgage, you would pay $730,000 in interest. Now, again, we're borrowing $1 million, and over 10 years on a 50-year mortgage, you would have spent almost 3/4 or 75% of what you borrowed in interest. So you're already paying back almost $750,000 on $1 million borrowed, as to where a 2% buy down would save you just over just around $180,000. You guys, a 50-year mortgage is not a solution for anybody, and I don't want anyone to think that it is. Now, what if you went the other way and we said, look, it's 50 years is nonsensical. How could I have about the same budget as I would need on a 30-year fix, find a better mousetrap, a better vehicle, a better product and solution for me, and I paid about the same amount, but I had a simple interest mortgage that paid principal first, then recalculated the interest based off of that lower principal month after month after month, and you don't adjust your payment. You keep making the same payment, even though your minimum required payment goes down, while your interest is going down every time you reduce the principal. That's the all-in-one mortgage. We're looking at an investment property for a client right now, taking effectively just the rents that they make on the property, and then using that rental income to pay the mortgage, right? So we're talking about roughly a $3,600 a month payment, principal, interest, taxes, and insurance on an investment condo. We contrast a 30-year mortgage, right, to the all-in-one loan. The difference is right here in front of you. It shaves 10 years more, actually, off the life of your loan, and saves this client almost $250,000. What's better, after the 19 years is over, they just take the funds that they were paying towards their all-in-one mortgage and use it to invest either in another property or further fund their investment vehicles that are outside of real estate. And they'll have access, as they pay down their loan on their investment property, all throughout the term of the loan. So whatever money they're putting to reduce their principal is greatly reducing their interest costs, further reducing their minimum required payment, and then accessible with the swipe of a card or any other way you would use a typical checking account. If we want a better solution, we probably shouldn't be listening to those shouting about 50-year fixed mortgages or the elimination of a 620 minimum FICO for conventional loans. I know I saw a lot of posts about this. We got a news bulletin internally about the elimination of the requirement for a 620 FICO for agency loans. Agency meaning like Fannie Mae, Freddie Mac, loans that typically have a very important factor for people that use them for the first time, and that's PMI, or private mortgage insurance. What's important to realize is that the headline might say elimination of 620 minimum FICO score, The reality is if you're putting less than 20% down, you're going to need private mortgage insurance, and 620 is by and large the minimum FICO required for PMI. In addition, PMI is priced heavily off of FICO score and debt to income ratio. And so if you're borrowing more and you've got a lower FICO score, more relative to the purchase price of the house, well, you're probably going to see a private mortgage insurance expense ratio that's going to drive up the cost even further. There's probably a better solution for it. FHA, if you're a first-time home buyer or low-down borrower. Obviously, VA, if you've earned that benefit, and others up to and including things like the all-in-one loan. So a lot of noise, not so much news. The 620 minimum FICO requirement for agency loans going away, not that big of a deal, and probably not the right shoe to wear if you've got a lower FICO score. Okay, because this is such a deep dive video this week, we've got a property that we want to showcase in Carlsbad, Rancho Carrillo. This is a condo, 3-bedroom, 2-bath, listed by Crystal Jocelyn and the Jocelyn team at Keller Williams in Carlsbad. Fantastic property. Even better, and why I'm not making it part of this video, is a list and lock value proposition. I've told you about list and lock. This property is relaunching with a seller credit of 2% with an additional 1% from us at CMG to drastically lower the interest rate and save a potential buyer on this property, not just a couple $100 a month, but more like $500 to $600 a month, or $7,000 a year or more. So that's going to be coming in a separate video. We'll link to it. List and lock, if you're interested in this property, you have buyers looking for a great first-time buyer home or a downsize home in Eastern Carlsbad, Rancho Carrillo area. This is the one. Look for the separate video. We'll link to it so we can show you the power of list and lock for buyers that are looking for a home that's more affordable.